Hello, everyone, and thank you for joining us. First, just want to say that our little disclaimer, our firm provides the information in this webinar presentation for general guidance only and does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for a consultation with professional tax, accounting, legal, or other competent advisors. And before making any decision or taking any action, you should consult a professional advisor who has been provided with all pertinent facts relevant to your particular situation. So we have a lot of, go ahead, Marty.
Let me just add a quick comment to that. Everybody always has to give their legal disclaimers, but what we're going to talk about with the incredibly uncertain tax environment, it's really important that everyone listening keep a couple of points in mind. First, there is absolutely no certainty as to what will happen and when it will happen. And that is a level of uncertainty that I don't know that I've seen many times in my 36 plus year career. Second, more than ever before, when you're planning in this kind of environment, because of the intricacies and interrelated nature of the planning, it's really critical that you approach planning with a team. You really can't do planning if your CPA isn't fully engaged, if your estate planning attorney is not engaged, your wealth advisor, and probably your insurance consultant as well. I don't think I've ever seen proposed changes that require a team effort more than what we're looking at right now. And third, it's really critical that everyone take this seriously, because we could have the most significant tax increases in the history of the country coming soon. So just keep that in mind along with the other caveats. Thank you.
Yep. So we have lots of information and changes to discuss, so we'll be going pretty fast. There's no need to take any notes, as this webinar is being recorded and will be released to all attendees with the presentation slides within 24 hours. We probably won't have any time for any live questions and answers, but please feel free to ask any questions in the question box, and some advisors will reach out to you personally to go through your questions and answers. The tax world, like Marty said, is likely going to be changing very soon in very dramatic ways. This program is designed to help you identify some issues you might discuss with your advisors to determine what current moves might be worthwhile for you and your situation. And you might benefit tremendously by taking significant action now before it could be too late. My name is Greg Munn. I'm a certified financial planner and CPA at Sachs Wealth Advisors. We do comprehensive financial planning and investment advisory for our clients, where our planning encompasses everything in your life, not just the investments. So other items such as insurance, debt, Social Security or pension or annuity strategies, budgeting, businesses, taxes, and of course, proper estate planning. It's very important, and we always make sure our clients have an excellent estate attorney as part of their team to round out their plan. And the next presenter I want to introduce is Joy.
Hi, everyone. I'm Joy Matak. I'm the co-leader of Trust and Estates for Sachs. I'm very excited to be here to talk with you about this important topic. And I'm really excited to be co-presenting with my friend and colleague, Martin Schenkman.
Thank you, everybody. I'm an estate planning attorney in New Jersey and New York, and I've written 42 books and probably 1,400 articles. I'm honored to speak with Sachs. I've worked with Sachs as a firm for decades and decades with many of the different partners, and I've worked with Joy for many, many years, and I'm honored to be here. And I promise you lots of really practical, actionable advice in this brief program that we're going to have.
All right, so with our agenda, we're going to be going over the changes that could be coming down the pike and how they will impact you. We'll look at the difficulties posed with transferring assets for protection and business succession. We'll discuss the importance of establishing trust now to enjoy greater flexibility in tax benefits, as well as any important planning steps to help protect and preserve your wealth for future generations. So let's get right into it.
Thanks, Greg. So in order to understand where we're going, it's really important to understand where we are. The 2021 exemption, at least so far, is $11.7 million per taxpayer, per US person. That's $23.4 million per couple. The exemption is the aggregate amount that can be given away during your lifetime. So essentially what happens on death is that we look back and say, what are all the gifts that you've made and what do you have left over in terms of amounts that you can give away? And that is how you get to the $11.7 million. Under current law, the exemption that currently exists is going to be automatically reduced in 2026. However, Congress is signaling an interest in reducing the exemption and raising taxes now, which is why we're talking to you today. We believe that 2021 could be a last chance opportunity.
Let me interject a very important point. If any of you on the call are looking at the numbers on the top line and saying, gee, 23.4 million, I don't have anywhere near that, don't make that mistake. The kind of planning changes that Congress is looking at will have a dramatic and harsh impact on lots and lots of people, even if your wealth level is dramatically below those numbers. So don't tune out. There's lots you have to do. And let me try something unconventional. I can tell you that I personally, my wife and I made significant transfers of assets last year, seeing the anticipation of what was coming, and this year again. I can tell you that, and we're going to talk about it in a minute, and Joy will probably explain it very soon because it's critically important. My wife is making a large transfer to her insurance trust to prepay, or not really prepay, but put into the trust as a gift, enough money to cover the next 12 to 15 years of insurance premiums. So even if you just are what you might view as an average wealth person with an insurance trust, or maybe you don't even have your insurance in a trust, you really have to move. But what we're going to talk about applies to everybody. And it's so critical that I'm sharing with you that I myself have acted in significant ways. This is not just something we're lecturing on. It's something that affects everyone on this call, including the speakers. Joy?
Absolutely. And that's, I think this is to your point. So what they're looking at is reducing the estate tax exemption from its current $11.7 million down to $3.5 million. And that means that you would only have up to $3.5 million to give away at your death. It's also going to limit lifetime gifting to $1 million, which could be critical for people who are looking to do transfers for other than estate tax purposes. Asset protection planning is a key issue that we'll be discussing. It's also going to increase the tax rate. So currently it's a flat 40% tax rate. We're going to see that tax rate change to a graduated tax scale from 45% up to 65% for those with estates higher than $1 billion. It effectively eliminates valuation discounts in most situations. And don't get hung up on the language here. We've got some examples that will help to solidify what we're talking about. The technical and structural changes that are in the For the 99.5% Act are actually more problematic than these exemption changes and tax rate changes, I think, because they're going to reduce the efficacy of various planning techniques that help everyone, like grantor trusts and grantor retained annuity trusts. These, we believe, are going to really rock the foundation of traditional estate planning. There's also going to be a tax changes on assets that are in trust after 50 years that are going to require special action by taxpayers, in contrast to current law that might permit trusts to continue forever without ever being subject to transfer tax. Fortunately, go ahead.
Let me interject a comment. I just want to do this to illustrate some of the details that you need to discuss with your estate planning attorney. So for example, if you do a GRAT, Grantor Retained Annuity Trust, if it's appropriate for you, under the new law, if you do a GRAT that doesn't have all these new criteria that they're going to incorporate, the GRAT fails. That means not that you don't get the result you want, but rather it's going to be treated as if you made a gift at day one. So for the first time in GRAT history, your attorney, when they draft a GRAT, may want to include savings language because we don't know the effective date of any of this. That's part of the unfairness and challenge and difficulty of all this. So if you're going to do GRATs, your attorney may for the first time want to include language saying something like, hey, if a Sanders type bill requires that this GRAT be 10 years and 25%, et cetera, et cetera, et cetera, those requirements shall be met. I'm not quite sure how you're going to deal with it, but you might need to address that. If you're setting up a dynastic trust, and most trusts, if not all trusts, should be dynastic in nature for a whole bunch of reasons, you may want your lawyer to put in something if this bill applies retroactively to this trust, and hopefully it won't, which is why you want to act now and avoid this, or at least avoid some of the restrictions. You may want to provide that the trust will have to terminate in 50 years. Otherwise, you may have a GST implication on the day you fund it. So I don't want to get too deep into technicalities. I just want to point out that the need to act quickly and the need to make sure that your estate planners are focused, your team, on some of the nuances of what we're talking about. Joy?
Yeah, and so one of the things I've gotten a lot of calls about lately is the Sensible Taxation and Equity Promotion Act, or the STEP Act. This is going to really change things. It imposes capital gains tax on inherited assets, very similar to the Canadian structure. And it could change planning and may even apply to transfers of appreciated assets made on January 1st, 2021, or retroactively. Planning may still be possible with some special precautions, and only the first $1 million of unrealized capital gains under the current form of the STEP Act would be exempt. Legislation is expected to allow taxpayers to pay the income tax that's going to be due on these, for these capital gains over 15 years, so that at least there's some relief. And there would be a deduction against estate taxes for any capital gains tax. But the loss of the step up in basis on death, and we'll talk a little bit more about that throughout the program, is really going to change how we look at planning and some of the things that we're going to be able to do.
If Joy didn't scare you enough with the dramatic nature of these changes, contemplate the following. If the STEP Act and the Sanders Act are both enacted, you could face the following. On death, capital gains have to be paid on all appreciation. If that gain is more than $1 million, you could be paying tax at a 39.6% rate. Call it 40%. Then what happens is whatever's left after paying the 40% cap gains on all the appreciation in your estate is you could be subjected to an estate tax. Let's call it 55%, because I think the 65 rate only applies to $1 billion and more. But
Right.
You could then, what's left, be subject to a 55% rate. Think of how little's left. Knock off 40% from what's left, knock off 55%. Now, it seems like they'll give us some kind of credit or deduction for the capital gains you pay at 40%. But nonetheless, even with that, depending on whether it's on the income tax return, on the estate tax return for the income tax paid, et cetera, this could collectively cut in half what you're able to bequeath compared to current law. That's huge. Another really important point. When Joy explained to you what the Sanders Act does, reducing the exemption from 11.7 to a mere 1 million for gift tax purposes, the logical thing to do from that is, gee, I better go out and set up a grantor trust to get grandfathering on that and give away as much of the 11.7 million exemption as I can. If your whole estate is $10 million, maybe you give away 4 million, 5 million. If your estate's 20 million, maybe you can afford to give away the 11.7. You want your financial advisor to do some forecasts so you know you're not giving away too much, and you got to do some numbers to look at it. But the problem, that's a great idea, and that's probably what everyone should be looking at doing. But now you have to add in the step provision. Okay, so I'm going to give away $6 million into a grantor trust. I get it. I'm going to lock that in because the gift exemption is going to drop to $1 million, and all these other restrictive, harsh changes may occur. but you have to be careful because a transfer to a trust, the step back is effective 1/1/21, retroactive to January 1. Now, I don't think they're going to enact that, but there's certainly more than a 0% possibility. So if you take your highly appreciated Apple stock and put 6 million of your Apple stock into a grantor trust that Joy designs, you better be careful because that under step back could trigger a capital gains at 20% under current law, and it could be 39.6%. So you got to plan with caution. And there's different techniques you can do to address that. You may also decide to take the gamble and not address it. But the point is, you really got to act. And this is some really costly stuff that you have to steer around. Joy?
And then there's another act that's floating around as well. This is Elizabeth Warren's annual tax on the net value of a taxpayer's assets. That's going to be 2% on assets over 50 million but under 1 billion, 3% on assets over $1 billion. It would apply to individuals and non-charitable trusts. There could be some aggregation of trusts, so you maybe want to be looking at that. It's not clear what planning might be done to help, except possibly trying to avoid an aggregation of trusts situation. So maybe you change your beneficiaries up or something. But this one is also something that's on the horizon, though I think less likely to pass. At least it's not getting as much traction as the STEP Act and the 99.5% Act.
One of the reasons, folks, is it's not as clear that a wealth tax will survive a constitutional challenge. And even if the things that Joy and I told you about the Sanders bill or the STEP Act, especially the retroactive nature of the STEP Act, sound like, boy, can that really be constitutional? Yeah, it can be.
Yeah, and look, no one knows what's going to happen this year, but I think it's hard to imagine that we won't see some type of tax reform. There are some very ambitious plans, ambitious spending, and there were pandemic losses that have really crunched the federal budget and exploded the deficit. That makes tax increases much, much more likely. The For the 99.5% Act has the most co-sponsors in the Senate currently. It also has the backing of the White House, but the president also campaigned on a tax proposal of eliminating the step up in basis on death. So some form of the STEP Act could also pass. Our point is you've got to prepare for the worst, hope for the best, act now, but act with caution.
And like I said a few minutes ago, I personally have acted on this because I think the harshness and the cost, and Joy and I have tried to illustrate that, are so significant. Everybody should act. If you're a physician or anyone concerned about asset protection, you need to jump on this fast. You really need to jump on it fast. I actually use a Ouija board, not a crystal ball, but while we can't predict anything, I think Joy's comment is spot on. I'd be shocked if we don't have a massive tax increase on high income, high wealth clients, people, taxpayers. I just can't see it not happening. The exact format of it, I don't know. My wild guess, and please, none of us can really predict anything. I could see a slightly modified version of Sanders and STEP happening in the terms of no basis step up on death, because that is really an incredible, I hate to use the word loophole, but certainly a dramatic advantage for the very wealthy that can afford to hold on to assets and not sell them in retirement for living expenses. I could see us losing the basis step up. I could see a Sanders Act proposed. And if you know, last year when Sanders proposed a similar act, the tax rates went up to 77%. He's already reduced it to 65%. Maybe they compromise with a $5 million exemption, because we're going to have that anyhow in a few years, and a 50% or 55% rate instead of 65. So, you could tone down the Sanders bill, add in the loss of basis step up. That could be what we see. So acting quickly is critical, but with caution, as Joy said.
Yeah, I think that what's important to note is that these are not the most progressive proposals that could have been made. That there are a lot of components of these two proposals, the For the 99.5% Act and the STEP proposal, the STEP Act rather, that have been adopted by the more moderate politicians and that have been touted by them for the last decade or so. You know, I mean, Obama had in his Green Book a lot of the provisions that we're seeing in the For the 99.5% Act, in the STEP Act. You're seeing those kind of come back. And as Marty pointed out, there is already apparently some moderation in the Sanders proposal, which make it a little bit more likely that something very similar to what we're seeing now could get passed. But here's a little bit about how it's going to affect tax revenue, where you have a $5 million estate. Under the current tax law, there will be no estate tax. However, under the For the 99.5% proposal, that estate of $5 million will be subject to $675,000. So that's a tax increase of $675,000 for a $5 million estate. Here in northern New Jersey, that maybe is not so far-fetched to have a $5 million estate. Moving up the ladder to a $25 million tax, you're seeing an estate tax proposal that would go from $5.3 million to $11.7 million, which is a tax increase of $6.4 million. And you can obviously read on the slide how that goes up from there with the larger estates. So
and by the way,
go ahead.
by the way, everyone, this is just the estate tax Joy is illustrating. She's not showing, in addition to that, the possible capital gains tax on death. You could have both of those. So, you know, on an $11.7 million estate, the tax could be substantially more than the $5 million.
Fortunately, the current draft of the For the 99.5% Act is not retroactive. The current exemption appears to be safe, and of course I say appears to be safe because we don't know what the final version of the bill is going to say until after 12/31/21. But there are provisions of the STEP Act that will be retroactive to the first of this year. So you need to be very careful, you know, watch where you step, to borrow a pun here. However, there are provisions of the For the 99.5% Act, which we want to really talk about and kind of, you know, hone in on. And that is valuation discounts will be largely restricted after enactment. Valuation discounts have long been decried by the progressive left as well as the IRS for their ability to allow some taxpayers to abuse them. So they've been looking for ways to reduce or eliminate the effectiveness of valuation discounts. The For the 99.5% Act takes a sledgehammer to them and gets rid of them. I don't even think that's hyperbole. Grantor trusts settled after the effective date or funded after the effective date will then be subject to the law. So we'll talk about that. Grantor retained annuity trusts are going to be almost completely ineffective after enactment. And as Marty had said earlier, generational planning is going to be altered. The effective date for the For the 99.5% Act could be as early as July or earlier, or as late as October, which means that we need to be starting our planning now. Any one of you that might be on the fence about whether to do planning really should get thee to a lawyer's office and start it as soon as possible. But you need to make sure that your practitioner is aware of the possible changes and plan with consideration to a retroactive date for the STEP Act.
Couple of quick comments. You can't only go to your estate planning attorney. You got to talk to your wealth advisor. You got to talk to your insurance consultant. You got to talk to your accountant. You got to get a Zoom meeting with everybody on it, because the nature of these changes is such you can't do a good plan without involving all of your advisors. There's a critical role for each. And even though GRATs may be ineffective, let me just clarify, GRATs created after the law becomes effective will be ineffective. I don't know that we'll even be able to use them again. But GRATs created now may be a phenomenal opportunity. So for example, if you have a robust life insurance plan and the restrictions that will prevent you from getting enough money into a trust or make part of that trust taxable and included in your estate, you may want to use GRATs today to pre-fund the insurance trust. So there's lots of good stuff you may be able to do today. And I'm saying may because, again, we don't know effective dates. We don't know what the law is going to be. But it certainly seems like pre-funding trust, getting a grantor trust in place. I think anyone on this call that doesn't have a grantor trust should at minimum get a simple, inexpensive grantor trust, if not a more robust one, just so you have something in place that's grandfathered and not covered by the greater restrictions under the Sanders bill.
So let's first talk about those valuation discounts, because it's something near and dear to my heart. And so in order to understand what a discount is, it's important to start with the definition of fair market value. And that is the price at which property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or to sell, and both having reasonable knowledge of all relevant facts. So what does that mean in English? Generally, what that means is when I give away a fractional interest, a quarter of an asset, or a 25% interest in an asset, you're going to pay less for that than whatever whatever 25% of the gross value of that interest would be, because you're not getting the whole. You're not able to sell it. You're not able to control it. You have to deal with the other 3/4 owner in order to, work with that asset. So because of that, we generally see some type of discounts in order to account for the differences in ownership between owning 25% of the gross value of an asset and 1/4 of an asset, which is markedly different. The 99.5% Act disallows discounts on non-business assets based on lack of marketability or lack of control. So we could talk about what those are.
Just a quick comment. What this act does is it zeroes in on some of the most powerful planning tools that we as advisors have used for decades. Discounts, as Joy just spoke about, are really one of the magic elixirs of estate planning. And they really targeted grantor trust, dynastic planning, crummy powers, discounts. They really thought through and did this proposal with knowledge of what techniques we as planners, Joy and I and others, have used for decades. So this is really a well-crafted, thought-out plan in terms of really restricting planning.
Yeah, and these proposed valuation rules are going to apply to those assets which are not used in the active conduct of a trade or business. And you'll get no discounts if the transferee and the family members have control or majority ownership. So next is an example of how valuation discounts can work. So in this case, Bernie has a $20 million estate, which includes a $10 million family business. He's going to gift 40% of the business to a trust so that the asset can then grow outside of his estate. The gross value of the 40% interest is $4 million, but a minority shareholder cannot control business decisions, cannot force a sale or redemption of the interest, and therefore the non-controlling interest in the business transferred has to be worth less than $4 million. It's not a dollar for dollar pro rata value of the underlying business. Thus, they engage a qualified valuation professional who concludes that the value of the 40% business interest transferred is worth only $2.4 million. Therefore, for gift tax purposes, it is only worth 1.6 million, or it is only worth $2.4 million, and you've reduced the value from 4 million by $1.6 million from this one transaction. So here are a couple of the discounts.
That's a great illustration. That's a great illustration what Joy did to show why you want to plan immediately. Look at the difference in impact with not only a much higher rate and a much lower exemption, but look at the leverage you're getting on this transfer today that may be gone tomorrow. So if you have business assets, real estate LLCs, don't lose those opportunities.
That's right. And in this case, you would see both a lack of control discount because a 40% owner cannot make important business decisions like declaring dividends, determining compensation, setting policies, or deciding when to sell or liquidate. And in order to account for that disadvantage, you get a discount for a lack of control. A lack of marketability discount is also appropriate. Whereas if I own AT&T stock, I can just go down to the market and sell it to any buyer. Transfers of privately held companies is a lot more difficult. The seller can't just put up the shares for sale to market and then they'd be ready to buy. Thus, the lack of marketability is going to force an investor to seek a price concession in order to compensate for being locked into an illiquid and long-term investment. These are the two types of discounts we usually see, and both of these discounts are hit hard by this new provision, by this new proposal. So here's how valuation discounts exactly work under current law. So in this case, Sheila wants to make a gift of her interest in real estate LLCs that own neighborhood shopping centers. Her interest in the LLCs is restricted by an operating agreement that limit her ability to sell her interests or control the entities, allowing the valuation professional to calculate the value as follows. So you've got the gross asset value of 16 million. That's the value of all of it. Then you take less, that you reduce that by a discount for marketability of 28%. That's a standard in the industry currently. That brings you down to the value of the non-marketable interest to $11.6 million. Then you attach a lack of control discount, reducing it further by another 5%. So the interest that Sheila owns in those real estate LLCs has dropped now from 16 million down to 11,020,000 dollars. For the 99.5% Act, assuming that those assets are not considered active, assets that are used in the active trade or business, would not allow Sheila to reduce the value from 16 million to account for her inability to sell or exercise control over the interests. Do anybody want to say anything about GRATs, Marty? So a grantor retained annuity.
Sorry, I was muted.
Okay.
There's some really creative and clever things you can do with GRATs. I don't think we have the time to get into all of them, but right now GRATs are a phenomenal tool and they'll be completely emasculated. And I think Joy said earlier, and I can't even think of how you could use one after these new laws become effective. Did you mention the 99-year GRAT? Do you want to talk about that?
We could talk about that. No, I didn't mention that, but it is.
You want me to talk or you want to talk?
Yeah, sure. Go ahead.
So one of the out there techniques, and it's certainly not without risk, but it's just to show you some of the creative things you can still do before these changes occur that will absolutely not be possible. And by the way, Congress and Sanders know that people were using this technique because they expressly provided in the Sanders bill that you can't use a GRAT for longer than life expectancy. Under current law, that seems to imply that you can, and it seems that you can't. You could set up a grantor retained annuity trust. So let's say you've used up all your exemption and you still have assets you want to give away and you don't know what to do. Well, a little Hail Mary before the law changes is put in a family business or just a big chunk of assets into a grantor retained annuity trust that lasts 99 years. You get an annuity payment back annually for that 99-year period. If you die during the term of the GRAT, some people mistakenly assume or say that the entire principle of the trust is back in your estate, which means you've accomplished nothing. That's not correct. When you die, technically the way you determine what's back in your estate, and this is clear in the regulations, it's not aggressive planning, is you take the annuity payment you've been getting each year and you divide it by the mandated federal interest rate in the year you die. Well, folks, if interest rates are at historic lows today, even though they've bumped up a little, they're still near historic lows. If interest rates are double or triple by the time you die, that may shift a huge proportion of the value of those assets out of your estate with no estate tax. So that's like a Hail Mary, just as one of the many strategies you may look at in sort of the waning days of tax planning opportunities.
Yeah, and so what Marty's talking about as far as the waning days of GRAT opportunities is that for the 99.5% Act has the following changes, structural changes to GRATs. One, they're going to require a minimum 10-year term. So one of the strategies that we haven't really talked about is a 2-year rolling GRAT term. So you set up the GRAT and then it ends in 2 years. And as you receive those annuity payments, you pour them into a new GRAT and you keep going. And this way you can leverage more of your wealth out without using any exemption. The maximum term is going to be limited to the lifetime of the annuitant, the person receiving the annuity, plus 10 years. So that will eliminate the 99-year GRAT opportunity. This is probably the worst part. The remainder interest in the GRAT, that's the amount that's going to be considered a gift for gift tax purposes, has to be equal to the greater of 25% of the fair market value of the asset you're transferring, or $500,000. And if the For the 99.5% Act gets enacted, everyone is going to be limited to $1 million gift tax exemption, which means that most people are only going to be able to create 2 GRATs without having a gift tax consequence. Probably not what you're looking to do when you want to use a GRAT. GRATs are going to become far less effective after enactment if these provisions remain in the final bill.
But that's only new GRATs. Ones
That's
you do
correct.
today should be fine.
That's
All right,
right.
let me just make a comment. If this GRAT discussion was kind of making you your head spin, just remember it's just an illustration of one of the many different techniques that you might use now and the opportunities and benefits it can provide you before the changes are enacted. That's the point of it. And Joy and I could easily make GRATs understandable to everyone on this webinar if we had an extra hour to talk about GRATs. It's perfectly understandable. But in the 5 minutes we have, we can't devote too much time to it because it's only one of the many things we want to talk about. I think the take-home message is you have some potentially incredible opportunities with GRAT planning if it works for you. And the way to find out if it works for you is to talk to all your advisory team. I keep stressing, not just one person, your entire team, because GRATs could be a phenomenal tool for funding your insurance trust and your insurance plan. GRATs could be a great Hail Mary if you used all your exemption. GRATs are probably not an optimal tool if you have lots of exemption left, because you may be better off using your exemption now.
Another way that the For the 99.5% Act creates structural change to planning is how it affects grantor trusts. Currently, when you move assets into a grantor trust, those assets are going to be able to grow estate tax free outside of your estate for the most part. Under the For the 99.5% Act, the value of assets transferred to a grantor trust after enactment of the Act, so that's important. It's not on January 1st, 2022. The way that the current proposal is written, it would be on enactment of the law. So whenever it gets signed by the president, at least that's how we're interpreting it at this point. I guess we'll see what comes out when the sausage gets made here. But based on the way that it's proposed, the value of any assets that get put into a grantor trust after that date, to the extent that that asset grows in value, the growth will come back into the taxable estate for estate tax purposes. So that is really problematic for people who like to use grantor trusts, because what we're really trying to do is use this vehicle in order to move assets out of someone's estate for estate tax purposes, and this proposal will pull them back in. Distributions, yeah, go ahead.
So let me just repeat something I said earlier, and I'm just repeating it because I think this stuff is so incredibly complex that I want to make sure some of the take-home messages resonate with all of you. If you're going to do more robust planning, you should absolutely proceed and do it and talk to your advisory team. If your situation is such that you're younger, your estate is smaller, you're still fence sitting, which is not a good place to be right now, you really need to be decisive. At minimum, consider having your estate planning attorney set up a simple grantor trust, because if you can get a simple, inexpensive grantor trust set up, that may give you the ability to have it grandfathered, meaning not, and I don't know why it's not grandmothered or grandparented, but they always still call it grandfathered, from these changes. So it may prove advantageous with the changes that Sanders is proposing, if they're enacted, to at least have a grandfathered trust. So that's sort of a minimum simple step that many of you may want to take if you're not already doing more robust planning. If you're doing more robust planning, I don't know that you need to create yet a separate another grantor trust, but you do want to have certainly at least one in your family planning arsenal.
So here's an example that kind of kept me up one night because it hit really close to home. So the inclusion of insurance proceeds in a trust. So in this case, we have a divorced attorney with 3 children who purchases a life insurance policy with a benefit amount of $5 million. It's a term policy. And she can use that to fund her children's education in the unfortunate event of her untimely death. She creates a standard life insurance trust using a template that she found online in early 2022 after the enactment of the 99.5% Act. She's going to die after paying approximately $240,000 in life insurance premiums. At this point, this divorced attorney has a relatively modest lifestyle. She managed to accumulate some assets and has an estate tax worth about $3.3 million as of the date of her death. And she has no debt as of the date. Under the 99.5% Act, because her estate is under $3.5 million, she wouldn't have any estate tax. However, because she set up this trust, this insurance trust, after the enactment of the 99.5% Act, the $5 million less premium payments paid would be included in her taxable estate. And as a result, the Act would force her estate to pay over $2 million in estate tax. Whereas under the law as it existed since 2009, there would be no estate taxes for this estate. So my take-home message to you is this is going to affect regular people. This is going to affect people who are just trying to take care of their families, who have modest estates, and who are just trying to, do the right things in order to, set their families up for success. And what people should be doing is to act now and set up and fund an insurance trust if you need to.
Just to reemphasize the really important point Joy just made, this is not only for uber wealthy people. These changes will have a dramatic impact on lots of people. A young family with a decent sized insurance plan, which probably every young family should have, because term insurance is very inexpensive, but they could end up losing a chunk of the coverage they want to protect their family to taxes if they don't do some of the planning we've talked about. Somebody like a doctor worried about asset protection, even if you don't have significant wealth. So please don't turn off the idea of the importance of planning immediately just because your estate's not $10 million or up. People with much smaller estates need to plan.
Yeah, and this is going to affect both trusts created after enactment and gift transfers to pre-existing trusts. So here are some more practical suggestions that we want to bring to your attention. Under current law, grantor trusts are still advantageous. Grantor trusts are disregarded for income tax purposes, which means that the grantor, the person setting up the trust, can pay income taxes while the assets in the trust can grow estate tax-free. The grantor can borrow from and lend to the trust without income tax consequences. So even though your lawyer is going to tell you you have to pay interest on any note that you may owe back to your trust, and you do, because your accountant's going to make sure you're doing it, you can at least do it without any income tax consequences. You can also swap assets that are in the trust, either by purchasing the assets using a note or transferring other assets of equivalent value. And that should be done in consultation with your advisors. The point is that grantor trusts offer significant flexibility while allowing you to freeze the value of the assets that are transferred to trust and allowing those assets to appreciate outside of the grantor's taxable estate. People should be setting up grantor trusts now before enactment of any new legislation. So here's some advantages of planning now. The 99.5% Act suggests that grantor trusts that are established before enactment may be grandfathered. Maybe we should switch it to grandmothered. I like that idea. The time before enactment may be this last chance opportunity. So again, it's not the end of the year. Don't wait. You've got to start working on this now because it's before enactment that everything needs to happen. Now note, there's no basis step up on the assets that are in trust, but if the STEP Act becomes law, that might not even be a consideration anymore because there will be no basis step up even on assets in your estate if the STEP Act becomes law in its current form. And remember, moving assets into trust isn't just for estate tax purposes, it's to help protect those assets from suits and claims, elder financial abuse, your kid's divorce, your grandkids' divorce. So there may be multiple, even non-tax reasons for you to act and act now. The For the 99.5% Act also has some really interesting changes to dynastic trusts. What's going to happen, and this is very technical, so I'm just going to kind of, explain it, at a high level. But what's going to happen in 50 years is that these trusts are now going to have an inclusion ratio of 1, which would mean that for any transfers made out of the trust to someone who is a skip person. A skip person is a grandchild or subsequent generation, generally speaking. There are some exceptions, which I'm not going to get into. But if any transfers are made to someone who is considered a skip person, then that transfer will be subject to a tax of probably around 45 to 55%. At least the way that the For the 99.5% Act is currently written.
Let me make a couple of comments, and let me preface my first comment by saying my comments are not political. Please, no one get offended. I'm speaking to you solely as an estate planner. There's no way that this provision raises a nickel of money for 50 years. And it's not going to necessarily raise a lot of money in 50 years either, because it will change the planning and it may take years after that before taxes is realized. The primary purpose of this provision is to address the increasing concentration of wealth in our country. It's a social, not a revenue objective. And that's important to keep in mind because I think that is part of the theme of what is going on with all these tax proposals. It's not merely raising income revenue for the federal fisc to pay for the various programs that President Biden has proposed, but it's also to address the social inequities. And that's a theme of a lot of this. And that has taken root. So you need to understand that and keep that in mind because it'll give you an understanding of the kind of changes that are being talked about and why some of them may go through, even if they don't raise revenue. Now, this will have a huge impact on dynastic planning. Very important to understand. You can't work around this. If you have a trust from 20 years ago, it's affected. If you do a trust today before enactment, which makes a lot of sense for all the reasons Joy and I discussed, it will still be affected. If you do a trust after the date of enactment, it will still be effective. So there's a number of ideas, and I think I rattled a few off very quickly earlier in our program of how you can plan to minimize the bite of this. But the bottom line, this is a change that will radically affect the ability of very wealthy people to pass wealth down multiple generations. Joy?
Yeah, and I wanted to talk a little bit about annual exclusion gifts. So a lot of you are very familiar with these, and mostly because you're using them to fund life insurance that are held by a trust. So currently, the annual exclusion for gifts is $15,000 per person, and you know that you can make crummy gifts to an insurance trust. Well, under the proposed legislation, gifts to trusts would be capped at 2 times the annual exclusion in the aggregate, meaning that you would only be able to put about $30,000 into any insurance trust without triggering a gift tax. So here's an example of how that might work. Jessica has a typical islet with crummy powers, and her premiums are $75,000 a year. This is easily covered by annual demand powers available to her children and grandchildren. With the new law capping that at $30,000 per donor indexed for inflation, Jessica's not going to be able to fund the premiums without incurring a costly gift tax on an annual basis. So one of the practical things that Jessica can do right now is consider transferring marketable securities or other assets to the trust using her exemption so that future premiums can be paid from a combination of the income and principal of that gift that would be made now. Alternatively, Jessica might be able to prepay future premiums in order to minimize the future income tax costs and gift tax costs. The value of planning now. I think we've been talking a lot about, different worst case scenarios and what might happen if this proposal becomes law. But I thought it would be really important to illustrate it with a case study. So in this case, the next two slides are going to illustrate how much this proposal would raise the federal estate tax for a married couple where each spouse owns approximately $16.5 million worth of assets. So the marital estate is $33 million. And the assumptions for each of the following two scenarios are this. For the 99.5% Act is enacted in its current form, and it's effective as of January 1st, 2022, save for those few provisions we've been talking about that were effective earlier than that. The couple enjoys a moderate 4% annual growth of the assets. On the death of the first spouse, is going to occur in 2022. The survivor spouse occurs in the next year. There are no taxable gifts prior to January 1st, 2021, and each state is going to have about $100,000 in administrative expenses. So the first one is simple planning. The spouses decide we don't need to talk to a lawyer, we want to use very simple planning, and they have a will, each of them has a will that establishes what's called an I love you credit shelter trust up to the federal exemption. And then the balance goes to the surviving spouse. So when the first spouse dies, $3.5 million is going to be shielded from estate taxes on that first death. As a result, the surviving spouse now has an estate worth approximately $31.9 million. And the federal estate taxes on the death of that surviving spouse, so there's no taxes paid when the first spouse dies. When the second spouse dies, that second spouse's estate is going to owe $13.8 million. So the family is going to wind up with about $17.5 million, and that includes the assets that are in the credit shelter trust.
Folks, that's just the estate tax. If the Van Hollen bill passes and you have a 40% capital gain on appreciation, those numbers are going to get really ugly. If they don't look bad enough to you now, they're going to get dramatically worse. And that's a possibility. Don't dismiss it.
So in scenario 2, the spouses listened to our seminar today, and they said, "Gee, we need to do some stuff." And I have to plug us somehow, Marty. So we need to do some stuff. So after the expenses of after the hearing us, they each decide to fund a trust for $11.7 million. So on the death of the first spouse, the value of each spouse's estate is about $5 million, right? Because remember, we had a $33 million estate. So each one had about a $16.5 million estate at the beginning of this scenario, and then we had a little bit of growth. So when the first spouse dies, each has about $5 million. After expenses of administration, the second spouse's estate is going to be worth about $9.9 million. Again, assuming some moderate growth, when that surviving spouse dies, the estate is worth $10.3 million. Using the calculations based on the current for the 99.5% Act, that surviving spouse's estate is going to owe $4.35 million. So let's contrast that with what the surviving spouse would have paid under the original scenario, number 1. In that case, they would have paid $13.8 million in estate tax. So there's a big difference between 13.8 and 4.35. Plus, the assets in the trust are going to continue to grow. So using this second scenario, that's a simple plan where each spouse funds a trust, probably for the benefit of the other, of $11.7 million, we're going to see the family wind up with $31.17 million rather than the amount that I had calculated earlier, which was only $17.5 million. So that's a benefit of $13.6 million. And I think I only charge a fraction of that in order to help you with your plan. So just to let you know, the
Keep in
13.6
mind,
million. Go ahead.
keep in mind, everyone, you got to move now. No one knows the effective date of these changes. No one knows what's going to happen. Second, and it's beyond what we can do, but just so you've heard the concept, if you create the kind of trust that Joy just talked about, you can't have a trust done for spouse one, change the names and use the same document for spouse two. You need to infuse into these trusts very different provisions in order to differentiate them. Otherwise, not only the IRS, but even creditors may not respect it. So you got to do pretty robust trusts. And also at this level of planning, I would suggest that you talk to your planning team about the benefits of putting these trusts in trust-friendly jurisdictions. Delaware, Alaska, Connecticut, Nevada, not New York or New Jersey. It's probably worth the cost. Well, let me rephrase that. I think, in my opinion, it's absolutely worth the extra cost and complexity of being in a better jurisdiction if you're dealing with this kind of wealth. You really want a better quality trust.
Thank you. And with that, we wanted to just do some final thoughts and takeaways. Marty, I just want to say thank you so much for taking the time to work with us today. And I think as our guest speaker, you should get the first crack at giving your final thoughts and takeaways.
Well, thank you, Joy, and thank you, Greg, and thank you, Sachs, for letting me work with my favorite accounting firm. I think that we're at an incredibly challenging time for planning. We've talked about some of the many different traps and potholes to steer around, but I think unlike any other time in history, if you don't plan and plan significantly and carefully and creatively now, you could lose out on massive opportunities. My guess, and it's no more than a guess, is that we will see major tax legislation. And if you wait to see what that legislation is, yes, you'll have more certainty, but it'll probably be too late. And the final word is, this is complicated. It's not a solo act. You got to have a team. You need a wealth advisor. You need a good accountant. You need an insurance consultant, unless your wealth advisor does that. And you need an estate planning attorney. And if you're transferring business or real estate interests, you have to have corporate and real estate counsel. This is, it takes a village to raise a child, if that's a phrase. It takes a team to do an estate plan.
Yeah, beware of any advisor who takes a go it alone approach. We should be collaborating and working together in order to get the best plan and product for you and your family. And that's really, I think, the most important takeaway. You want to be planning with flexibility because no one has a crystal ball and can tell you what's going to happen. And so planning now, but with caution, is really, really important. And I think that, the thing that I get from reading this proposed legislation is that these are really structural changes. These are not just, don't focus just on the top line $3.5 million exemption and 55% estate tax rate, which are important. Don't get me wrong. But it's not just those top line, numbers that you can see on a billboard, for the next campaign. It's really the structural underlying changes to how we plan and the things that are available to you, the options that are available to you now, but may not be available to you by the end of the year, that are really important for you to understand. And we really hope that we have the opportunity to talk with you greater about this so that we can answer your questions. Thank you so much for your time and attention today.
Yeah, my only thought is just wow. A lot of good stuff. Thank you, Joy. And it's still only just one piece of it. We still don't have the final word. So kind of like you and Marty said, reach out to your advisor and your estate attorneys now. Get planning.
Thank you, everyone.